Hi, my name's Alastair, and today we're going to take a look at the Wolf of Wall Street movie.
We got plans up here that's gonna take this company into the fucking stratosphere!
The movie is about Jordan Belfort and his life, and he was a boiler room sales guy, which was selling penny stocks to vulnerable investors. He starts his career, though, at a bulge bracket broker-dealer on Wall Street, and that's where the movie starts. Now, a broker-dealer is a company which tries to put together investors who want to invest money on the one hand, and people like companies who want to raise money on the other. And they do that through the financial markets. So they take companies, issue stocks or issue bonds, and then they get their sales team to sell those securities to the investors. And they will also provide after-sales service, so they will resell them for the investors too. So let's take a look at the first clip where Jordan actually starts his first job.
So what do? I go to the one place on earth that befit my high-minded ambitions.
You are lower than pond scum. You got a problem with that? Jordan?
No problem at all.
Good, because that is what you are, pond scum. Your job is connector, which means that you will be dialing the phone over 500 times a day, trying to connect me with wealthy business owners. And until you pass your Series 7, that is all you're gonna fucking be doing. Sit. Sit! Just so you know, last year, I made over $300,000. The other guy you'll be working for, he made over $1 million.
$1 million? I can only imagine what a douchebag that guy must be.
Jordan Belfort.
So in the first clip, you can see Jordan is being introduced to the bank, and he's got a pretty horrible first person he sees. Nowadays, I doubt that would happen. But what he's joining is a sales team, and you can see there's lots of activity. It's the trading floor, and he has to make lots and lots of calls a day. And that's colloquially what we used to call in the business smile and dial.
Smile and dial.
So he would have to talk and try and find wealthy investors who want to invest in the stock market. Now, what they also go on to say is that he's got to pass his Series 7. Now, the Series 7 is a regulatory exam in the United States, and you have to pass that before you do any kind of client advice. Now, normally, you would probably have to pass that before you even talk to clients. So it's a little unusual that he'd be allowed to be cold calling clients without passing his Series 7. But we can kind of, I guess, treat this as a Hollywood movie. But doing 500 calls a day is a pretty intense experience. Now, normally for the big firms, they will have pre-existing clients. And typically what the salespeople would be doing on a day-to-day basis is taking ideas from the research team and the in-house economists and pitching them to investors, usually in the context of particular stocks, or if they have a new issue or an initial public offering where they're taking a company public and they're selling shares into the market.
Well, pleasure to meet you.
And you as well. I see you've already met the village asshole.
Smile and dial. And don't pick up your fucking head until 1.
Hey, fuck him. I'm the senior broker here. He's just a worthless piker.
Why don't you blow me, Hannah?
Now, did you really pitch a stock in your job interview?
I had to do something to stand out, right, sir?
I fucking love that. Lunch today.
Yeah. Right?
We don't start dialing at 9:30 because our clients are already answering the phone. 3, 2, 1, let's fuck!
Now in this latest scene, Jordan is on the trading floor and you can feel the intensity and the activity, and they're talking about smile and dial. But he also mentions that Jordan pitched a stock in his interview. Now, in some cases, you do get asked to do that. You will get asked to sell something, particularly if you are interviewing for a sales job. And a classic one is, sell me this pen, and you have to sell the pen back to your interviewer. But you could also pitch a stock, so it would be a good idea if you are interviewing for a sales role to have a kind of investment idea that you could pitch to them. Now, the truth is, in the industry, there's been a big shift towards allocating investments to passive investing. And what that means is that rather than stock picking, what you're doing is you're investing in a broad index of stocks or bonds. So you're really allocating assets to particular asset classes as opposed to cherry picking the winners and losers. And that's been a really, really big growth in the sector. And typically that's done through something called an ETF, which stands for an exchange traded fund. Now, later on in the clip, you can see that the stock market or the market is opening at 9:30, and you see this kind of anticipation, and the clock goes, and then everybody starts hitting the phones. The reality is, normally in the trading floor, the day would start very early, maybe 7 a.m. with a morning meeting. And in the morning meeting, you'd have the bank economists giving an overview of what's going on in the markets and in the economy, any key stats or numbers coming out in their view and their expectations about what they would be. They would also talk about any new issues or initial public offerings that are being offered to investors then as well. And then you'd start actually calling before the market opens.
Done! Time to paint the tape. Woo! A 2000 Microsoft going in the hole. Come on. Ah. It's alive. It's alive. Hold on to that. It's hot. In. Shut that motherfucker. Shut it. So!
Now, in this latest clip, Mark Hanna is making a trade in Microsoft stock. So he's got an order from a client, and he's writing out the order on a sheet, on a bit of paper, and then he's rolling up paper, and they walk over to the wall, they open a little cabinet, and they put it in a little kind of a tube, and they put the tube in, close the door. Now that is a pneumatic tube, and that will be driven by air, and it will go to the people that will record the trade in the telex room to record that there's been a sale of stock. Now that isn't, of course, in the old days. That doesn't happen anymore. None of this is paper-based. Everything is electronic, and all those decisions, you will just be able to press a button on a keyboard, and then suddenly the trade will be recorded. So this is kind of old school. It's decades in the past, this kind of activity. But it kind of gives you a sense of what's going on. And he's talking about painting the tape, and that is where the ticker tape, if you remember the screen where you have a rolling series of acronyms and numbers, that is the ticker for the stock, which is typically a 3 or 4 letter code. So alphabet, or now it's now called Google, is GOOG. And then you'll have a number, and that will be the price of the latest trade in that particular stock. And that's what the ticker tape is. And that's what he means by painting the tape. It's going to go, that trade will go onto the ticker tape display, which will represent the latest trade in Microsoft's stock. Now, of course, nowadays this doesn't happen. And one of the things that's happening systemically in the market at the moment is that the trading floors are getting smaller and smaller and smaller. So in Stanford, UBS used to have a really, really huge trading floor. Probably had close to 100,000 people on it. And now that, I think, almost doesn't exist anymore. And the reason for that is so much of the trading floor is now becoming computerized. And there's a smaller and smaller component of people being involved in that.
Mr. Hanna, what can I bring for you on this glorious afternoon?
Well, Hector, here's the game plan. You're gonna bring us 2 absolute martinis. You know how I like them, straight up. And then precisely 7 1/2 minutes after that, you're gonna bring us 2 more. Then 2 more after that, every 5 minutes, until one of us passes the fuck out.
Excellent strategy, sir.
I'm good with water for now, though. Thank you.
It's his first day on Wall Street. Give him time.
Now in this clip, Mark Hanna has taken Jordan up to the partners' dining room, and it's a kind of fancy floor of the corporation or bank or broker-dealer in this case. And it's usually on the top of the building, and there'll be white tablecloths, and it's typically where you would entertain clients. But also, in the past, often the partners, in other words, the top of the tree in the firm, because a lot of the broker-dealers used to be partnerships. For example, Goldman Sachs was a partnership and then became a IPO and a traded corporation. But in the old days, you would have had this dining floor and you'd take clients up to the dining floor, and the partners would dine on the floor every lunchtime as well. Now, many, many decades ago, you would have had alcohol at lunch, but suddenly in the United States, that is almost unheard of nowadays, and it would be seen as really, really bad form if you ordered an alcoholic drink at lunch. I guess if a client did it, it wouldn't be so bad, but it would be very, very unusual to see alcohol consumed in one of those in-bank restaurants.
Then, I was a licensed broker at last, ready to make my fortune. My first day as a future master of the universe.
Now in this clip, they're talking about a few terms that are worth talking about. Firstly is master of the universe. So a master of the universe is somebody who is kind of top of the tree, leader of the game that everybody looks up to. Another term, which is not dissimilar, it's not mentioned in the movie, is a BSD, but you do still hear people talking about that. And that stands for big swinging dick. And typically it was used when the industry was more male dominated, but it's typically a managing director or a senior person who really throws their weight around, usually in a pretty negative way.
I have X on it, 86 and a quarter 6 months ago. Today it is trading at 36 and a half. Mr. Butt.
Now in this quick clip, they're quoting stock prices, and I just wanted to mention something really quickly here. They're quoting prices in fractions, and that's certainly how stocks used to trade, and bonds as well. They would typically trade in 1/8 or 1/4, sometimes 1/2, and you'd have to know fractions when you were trading, and so that hence is why typically as a trader you need to be really good at mental arithmetic, being able to quickly be able to understand how fractions add together and be able to do quick calculations. So that's a key thing if you want to be a trader, is to be very good at mental math.
A boat, maybe.
Is this stuff regulated, or are you guys, what are you doing here?
Sort of.
Sort of? Jesus Christ, the spread on these is huge.
Yeah, and that's the point. What's your name again?
Mine, Jordan Belfort.
Jordan, what do you get on a blue chip stock?
I make 1%. I did make 1%.
Pink sheets, it's 50.
It's 50%? 50% commission?
Yep.
For what?
It's our markup for our services.
So if I sell a stock at $10,000, my commission is $5,000.
If you sell $10,000 worth of this stock, I will personally give you a blowjob for free. And I hope it happens.
Hello, John. How you doing today? You mailed in my company a postcard a few weeks back requesting information on penny stocks that had huge upside potential with very little downside risk. Does that ring a bell?
Now in this latest clip, you've got Jordan who's lost his job at the big Wall Street firm and has come across this small shop selling penny stocks to unsuspecting investors. And typically that would be known as a boiler room, where they're doing high pressure selling to pretty unsophisticated investors. And one of the ways in which you can see they're making money is that there's a massive difference between the price that they will sell you stock at, which is the offer price, versus the price that they will buy stock from you, which is the bid price. So this means that if you are buying a stock from them at $100 and they want to sell it back to them, they will offer you $50. And that is that 50% commission. So it's a huge, huge commission. And it's funny when they're talking about regulations, usually these are kind of on the very borders of regulation. It's a kind of grey area, and a lot of them get shut down for the high pressure selling because you have some key things that you need to understand about, is this product that you're selling good for that particular investor? And in most cases, the boiler rooms don't do anything in the interest of the investor. They're just trying to offload junk paper to the investor. And that's exactly what's happening here. But of course, they're making a lot of money from each trade in particular.
Right now, John, the stock trades over the counter at 10 cents a share. And by the way, John, our analysts indicate it could go a heck of a lot higher than that.
So here they're talking about over-the-counter trading. And there's generally two types of trading. there's over-the-counter, where you have to go through a broker. So you'll call a broker and say, I want to buy this stock or bond at a particular, well, the broker will actually give you a quote, a bid-ask spread, which is how much they're willing to buy it or how much they're willing to sell it to you. So that's over-the-counter trading. So it's kind of like going up to a counter in a store and saying, I want to buy something directly from a person. You'll generally find in the stock market, very, very illiquid stocks will trade over the counter. And in the bond market, traditionally, it's all been over the counter because bonds are a lot less homogeneous than, say, stocks. So a single stock, for example, Coca-Cola's shares are all the same. But Coca-Cola will have lots of different bond issues at different maturities. And so that's why they're traded over the counter. The difference to over the counter and exchange trading, in an exchange, what happens is the orders kind of get aggregated and then they get filled by the exchange. It's almost like a wholesale market, the exchange, but individual orders will come into the exchange and get settled, and it won't be directly person to person like over the counter is. So in this case, the reason they're trading over the counter is that these are penny stocks and they're not actively traded. They're very illiquid, hence why it's OTC trading.
End of the month, 28.7 million in gross commissions, all from pink sheet stock, boys!
So in the film, we've had two references to certain types of stocks. We've had pink sheet stocks and we've had blue chip stocks. Now, pink sheet stocks come from the name of the color of the trading slip. And the reason it's pink is because it's an over-the-counter trade. So you're doing it with a broker. And they write up the trade on a pink slip, hence the term pink slip stocks. Typically, they're very illiquid or penny stocks. And they get called pink sheet stocks, generally low quality. At the complete other side of the spectrum are blue chip stocks, and blue chip stocks are the very safest household names, typically IBM, etc. And they're called blue chip stocks because that comes from poker, because you have different colors of the actual plastic chips that you bet with in poker, and the highest value chips that you bet with are blue, hence the term blue chip stocks. So those are the two references that they're making in the movie.
Yeah. Jordan Belfort, sounding like a kind of twisted Robin Hood who takes from the rich and gives to himself and his merry little band of brokers. Read that. Read it.
Listen, there is no such thing as bad publicity, sweetheart.
Read the article, babe.
Jordan, you look great. You're in a huge magazine.
Fucking deal I look.
Mr. Belfort, give me one chance. Can you look at my resume, please? Belfort, excuse me, sir, please. Just take a minute and look at my resume.
How's all this? It's the Forbes article. They all want to work for you now. Hey, what did I say?
Just gotta be nice.
Hey, you want a job?
Give me a minute, Sorry, Mr. Belfort.
Forbes made me a superstar. Every day, dozens of money-crazed kids beat a path to my door.
Now, the really interesting thing about what's going on here is that this has real corollaries to a book called Liar's Poker. When Michael Lewis, who worked in investment banking at Salomon Brothers, wrote Liar's Poker, where he left investment banking and then wrote the book, which was really a kind of expose of the bad behavior and the bad practices within the industry. When he wrote that, he really wrote it as a kind of health warning. Do not join this industry. But in fact, it had completely the opposite effect. In fact, it became legendary to read before you went into the industry, and it almost encouraged people to go in and make lots of money. And that's kind of exactly what's happening here in the movie. You've had some bad publicity, but actually bad publicity has created good publicity because it's encouraged people to join because they want to go and make their fortune. So it's a very interesting corollary with what happened with Liar's Poker. And it's actually a great book, along with Monkey Business, as a bit of expose on the industry.
Enter our new securities attorney, Manny Riskin.
This is the SEC.
$700 an hour to be the voice of doom.
Listen to me. You piss up the SEC's leg, you end up with your tits in a ringer.
Will you not worry about it? I have the SEC under control.
What the fuck are these imbeciles doing? Hey! Hey! What are you doing? Hey! We got the SEC in here. 15,000.
The Securities and Exchange Commission sent 2 lawyers down to review our files.
So finally, Stratton Oakmont are being investigated by the SEC. And the SEC is the Securities and Exchange Commission. They're the big deal regulator on Wall Street. And they regulate amongst other entities, broker-dealers. And broker-dealers are essentially people selling and buying stocks and bonds from investors, and also help corporates and governments issue into the financial markets, whether it's stocks or bonds. And the SEC is a kind of overriding regulator. So it's a really big deal they're getting an investigation by the SEC. Now, historically, people like Goldman Sachs and Morgan Stanley were broker-dealers. JP Morgan, on the other hand, was historically a bank. And the bank regulator is the Federal Reserve. And in the financial crisis, a lot of the broker-dealers, like Goldman and Morgan Stanley, were forced to convert into regulated banks in order that they could access capital. In some cases, the actual regulators kind of forced them to do that. So now the Federal Reserve will also regulate people like JP Morgan, Morgan Stanley and Goldman Sachs, as well as the SEC. But in the case of Stratton Oakmont, they are just regulated by the SEC, and firms like Jefferies will be regulated just by the SEC because they are not a Federal Reserve bank. They're just a broker-dealer.
We're gonna cut in the lobby. I caught a genius.
Enter Steve Madden,
Great American cop.
red hot ladies footwear impresario. And thanks to Donnie, we were taking his company public. Stratton Oakmont was crawling out of the primordial ooze. Pond scum no more.
That's why they gotta see your face.
You get them fired up so they push the shit out of this stock, okay?
And not only that, Donnie and I secretly owned 85% of Steve Madden's shoes, which legally speaking was a big no-no, but we'd get filthy fucking rich if our troops got behind it. Our job was to get them worked up, but not too worked up.
So here they're talking about taking Steve Madden, which is the footwear company, public. And what they mean is they want to launch its shares onto the publicly traded exchange in an IPO, or an initial public offering. Now, the reason they get involved is that Steve Madden is running his business. He has shares himself, but he doesn't have any relationships with investors. And that's why he needs a broker-dealer like Stratton Oakmont, who actually has lots of relationships with different pools of investors. And that's why in an initial public offering, you will get an investment bank or a broker-dealer to manage that process and firstly introduce the firm in a management presentation to investors, maybe write some initial research on the firm, and then build a book. In other words, literally talk to investors and say, would you be interested in buying stock in this kind of price range? And you kind of soft circle some orders, and some of those orders will just be hard orders at any market price. Some of the orders will be, well, at this price we'll have more, at this price we'll have less. And you will kind of build a book of demand. And then once you are pretty satisfied you've got enough demand for the issue, then you will do firm pricing and then launch the stock on the exchange. This is extremely lucrative. In the United States, the initial public offering fees, the underwriting fees, where the broker-dealer will buy the stock directly from Steve Madden and then turn around and sell it to investors, can be range from 4 to 7%. So it's a really big deal. And in this case, it's putting the firm on the map almost on the same level as some of the other major firms operating in the industry.
At 1 p.m., we opened the stock for sale at $4.50 a share. By 1:03, it was over $18. Even the big Wall Street firms were buying.
Now, here they're talking about the actual pricing of the issue. So they've talked to lots of investors, they've kind of built up a book of demand, but they haven't given the final pricing. And then they give the final pricing, and then the price jumps. Now, generally speaking, in an IPO, you want an increase in share price, but not too dramatically, because if it jumps too dramatically, it potentially means that you've underpriced the offering, and you don't want it to drop. So immediately after the pricing, what tends to happen is that the investment bank or broker-dealer will get involved in price stabilization. And what that means is they will have the ability to issue slightly more shares if the demand is, or the price is increasing dramatically. And by issuing more shares into the market, that will dampen the demand because supply is expanding. And that's known as the green shoe option, which is usually a 15% over allotment option that the investment bank can execute. But if the share price drops, then what happens? The investment bank will go out and buy stock. And you're thinking, wow, they're trying to catch a falling knife, right? They could lose money. However, the investment bank, when they do the initial offering, will normally get a few key investors, and they will offer those shares to those investors, but they won't actually execute on the trade. So they effectively will have sold more stock than they actually have in their inventory, will be able to deliver on. And if the stock price drops because they're effectively short, it means that what they then can do is go out into the open market and buy stock, and then use that stock to satisfy those investors that they agreed that they would actually deliver the stock later to. And that's known as price stabilization. And generally speaking, that should mean that the stock price generally slopes upwards after the issue. In examples where it doesn't work, i.e. Facebook, what can happen is you can just run out of the short that you are in the stock, so you just can't afford to buy any more shares, otherwise you'd be making a loss because the share price is falling. But that is called price stabilization. Now, in the movie, you can see there's a direct conflict of interest because Stratton have actually owned stock secretly themselves on their own account, and what they're doing is they're pushing up the price and then they're offloading it for a profit. So they're buying at the issue price, and then they're selling it at 18 and locking in those few dollars profit and making money. Now that's a direct conflict of interest, and that's an absolute no-no. You would not be allowed to do that as an investment bank. But you can be involved in price stabilization. And ironically, price stabilization can be profitable because, particularly if the share price is falling, because you are short, and let's say you are issuing the stock at $14 and the price drops down to 12, well, it means what you will do is buy stock at 12 and satisfy those over orders at 14 and to make a profit of 2. And the investment bank in the Facebook issue, where the stock price dropped and they literally couldn't keep it from dropping, the investment bank made $100 million on that short stabilization. Now, that's not a good thing, because what it does, it trashes the reputation of the firm that has potentially mispriced the IPO in that process.
Exactly. It just, it bothers me. We're the new guy, and we're the one that's banging on Wall Street's door. I mean, you should see what's going on at the bigger firms. I mean, I know all the information. It's true. Goldman, the Lehman Brothers, Merrill, collateralized debt obligations, this internet stock bullshit. I mean, it's a fucking travesty. I mean, I could take you step by step to what exactly is occurring. All you have to do is ask. I'm available.
So here they're talking to the SEC, and you can see here he is trying to obfuscate his activity, and he's talking about other things that are going on in the financial markets, one of which is collateralized debt obligations, or CDOs. And CDOs were really one of the key drivers behind our financial crisis that we had in 2008. And CDOs is where an investment bank says, look, there are lots of bonds outstanding. What we can do is we can collect all those bonds and put them into a new trust. And so the trust owns these bonds. And then what we can do is kind of liquidize them and then sell new bonds backed by that collection of securities that they've put into the trust. Now you're thinking, why on earth would you do that? That seems kind of crazy. Why not just stick with the original bonds? Well, it's all really about a credit rating arbitrage, because what they did is say, look, if we put lots of different bonds at different credit ratings into the pot, what we can do is we can essentially sell securities that on average will have a higher credit rating, because on a statistical basis, there's a lower risk of default because you are spreading a risk over multiple securities. So effectively, it's a kind of credit rating arbitrage. And what you're trying to do is take a collection of stocks, putting them into a big pot, sell new securities that effectively will have a higher credit rating. A higher credit rating will mean a lower yield. So this means that you can sell the new securities at a higher price than you bought the old securities, and you can make money that way. And actually, to be fair, it's got a valid reason or valid opinion that there was a lot of abuse going on there because people were essentially gaming the credit rating situation, and trying to understand the credit rating models and find ways around to get a better credit rating for the new securities that they were issuing. And the dot-com boom, obviously there was a huge bubble there that burst. But nevertheless, what they were doing was absolutely illegal. And frankly, in today's world, with the internet and the massively increased level of compliance and oversight since the financial crisis, this would be a lot more difficult to do now than it would have been pre-financial crisis. That's not to say it's not going to happen. That's not to say there's not fraud. Absolutely, that will happen. But I think it's less likely that you'll have a whole firm operating like this in the movie in today's world. But nevertheless, it's a great story, and it's a true story. This actually happened, and you can read Wikipedia, and it's a great movie because it really gives you some color to what was going on in those events.
Yeah, look, I know you're not following what I'm saying anyway, right? That's okay, that doesn't matter. The real question is this: was all this legal? Absolutely fucking not. But we were making more money than we knew what to do with.